Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is Stocks in Focus, the show that gets you the stocks that are buzzing in trade on account of, well, several reasons, mostly fundamental in nature. And we'll get you the analyst recommendations as to what to do, whether you should add to your positions, whether you should take a fresh position in any one of these names. Joining me now on this conversation is Mayuresh Joshi from William O'Neill. Thanks so much, Mayuresh, as always, for taking the time, and pleasure as always speaking with you. Interesting list of stocks. Let's start going down the list. The first of them is PCBL, the erstwhile Philips Carbon Black, and it's buzzing in trade today. It's hit a 52-week high, and this is ostensibly on account of the company commissioning the first phase of a brownfield specialty carbon black expansion at Mundra. How significant is this business development?
Morning, Alex. Pleasure to be on your show as well, and good seeing you after a long time. For Philips Carbon Black in particular, it's a leading manufacturer of carbon black. Carbon black, as you know, is the reinforcing material that are used in tires, and tires are very much in focus because of the new launches that we are seeing and the enthusiasm in terms of bookings, whether it's two-wheelers or four-wheelers. Having said that, the recent commissioning that is probably happening, it's the new carbon black plant, and the specialty carbon black plant, which so far fetched around 9% of sales volume, can be expected to grow quite significantly with this commissioning over the next few quarters. Again, margins are extremely high in this line of the business, and therefore, with the combination of both the specialty carbon black and the specialty grade carbon, which they are probably entailing as well, volume and value growth over the next few quarters will be very, very evident. Now, the expectations with these developments is that EBITDA margins can now significantly improve over the next 2 to 3 years, and they can actually improve to anywhere between 14 to 15% in that range. And the EBITDA per ton can also be improving to the extent of 17,000, 16,500, 17,000 as a base case scenario, which is significantly higher from the current levels. So healthy cash flows, inexpensive valuations probably is something that can keep the stock in momentum.
Okay, so taking forward, and just to follow up on that, this is a stock that has gained about 30%, 31% in the year-to-date period. Is that kind of, you say that valuations are still attractive. So therefore, based on the kind of expectation or improvement, as you say, in EBITDA per ton and realizations, I think, will you have to re-rate, and do you think that it's still attractive at this point?
It will, because I think the entire earnings perspective is still not embedded into the stock price. Okay. Even if you probably put an EPS estimate of 16.5 rupees on an FY25 basis, and even more on FY26, as the commissioning happens over the next few years and volumes and value builds up on the balance sheet, the earnings growth can be even further on an FY26 basis as well. So yeah, I think there is still scope, in my opinion, for PE expansion.
Any downside risks?
Slowdown in the auto industry itself and increase in input costs. I think those are the only two aspects which are key risks.
Vedanta is the second counter that I want to focus on. And of course, this is a company that has been in focus for various reasons. But the latest headline, of course, is the pulling out of Foxconn from their semiconductor joint venture. The company says that it's still keyed up or still geared up to continue with its plan to set up a fab unit here in India. But what do you read from this latest development?
So I think the initial statement came as an knee-jerk reaction yesterday morning. But both Foxconn and Vedanta, apparently, as we are reading in from news reports, are saying that they are still sticking in terms of their agenda as well. Having said that, I think this news might be sentimental in nature at this point of time. But probably if you look at the core business, Alex, for Vedanta itself, I think the entire perspective in terms of the China reopening trade is going to be a key determinant in terms of prices for the commodities that they probably sell. And therefore, I think with LME prices expected to stay low, with the Chinese recovery still expected to marginally improve over the next couple of quarters, my own sense is that the operating leverage does not meaningfully get played out in terms of balance sheet as well. Now, they also need to deleverage their balance sheet, and therefore, I think the kind of cash utilization that has happened in Zinc's balance sheet, the dividend payouts that have come to the parent as well, can be useful in terms of repayment of debt. But I think these core fundamental factors might hurt earnings for Vedanta, at least in this financial year, and therefore we've got a neutral call on this market.
Debt and the requirement to deleverage the biggest overhang for the company, do you think?
Yes, I think because that is one aspect that not just institutional investors in India, but even foreign rating agencies and institutional investors in the parent company are.
Okay, so given that and given that overhang, what do you think that the investor should bear in mind if they have not taken a fresh position in Vedanta, they've not bought into Vedanta? Should you wait on the sidelines to see some of those issues be resolved?
Well, yes, and that's precisely why we're maintaining a neutral call for Vedanta. One, I think how does the deleveraging happen over the next few quarters in lieu of the fresh capex that they're probably putting in, and what kind of impact that does have on cash flows. And the second aspect in terms of the macro developments for the overall sector as well. I think are you seeing some green shoots come through, which will give us an indicative requirement that things are probably starting to turn.
Okay. The third counter that we're discussing today is Varun Beverages. And I mean, it's done quite well for itself. The stock price also reflecting that. But the latest was a report that I was reading that talked about its foray into the flavored milk business and the fact that there is quite a lot of potential, according to that note that I was reading, 25% CAGR in that segment as a whole over the next 5 years or so. And Varun Beverages is planning to triple its capacity in that segment. So value-added services for milk products as well as the energy drink that it has and various other aspects seem to be going well for this counter. What do you think about that segment of its business, and are valuations attractive at this point?
You answer your question, Alex, in two parts. The first part itself in terms of the overall composition of its product mix. If you probably look at last financial year's numbers, 71% constituted from the CSD part of the business, which is Pepsi, Pepsi Black, so on and so forth. Around 22% from water and 7% from juices as well. But to a large extent, with a lot of backward integration that is happening in terms of PET manufacturing, PET resin, so on and so forth, EBITDA margins can sustain around that 21-22% mark, which they have probably delivered in the last financial year. Volume growth has been stupendous for these core businesses. 802 million cases, Alex, in the last financial year compared to 569 million cases the year before, which shows the inherent strength of the business itself. Now, the foraying into the new business segments, which is flavored milk products, I think a lot of FMCG companies also tried doing that in the past, and they do take time in terms of probably having their footprints strongly entrenched in the kind of new business lines that they're venturing into. So it's a new business line. Now, how much of volume and value growth can probably come through as the base builds up, and how consistently can they deliver is a question that we probably need to see numbers getting delivered over the next few quarters. When it comes to the second part of your question in terms of valuation, obviously the stock has given a one-way move over the last few quarters. And therefore, if you probably look at it from their standard deviation averages in terms of price earnings multiples over the last 3 to 5 years, they have delivered strong growth over the last 3 years. Can they compound this growth to sustain those valuations in terms of the premium that they're delivering at this point of time? Numbers will probably do the talking. So to answer your question, valuations a little bit on the higher side. On the only lens, it's a late stage base, which means it can succumb to significant amount of profit booking if they miss numbers for any reason in any particular quarter or a couple of quarters. And therefore, I think fresh investments should probably be looked at significant pullbacks.
Okay, interesting. So that's the view on Varun Beverages. HDFC Life also in focus, and I think private insurers, this is on the back of its business updates. Total premium growth increased by 18% year on year for the life insurance sector as a whole. Private sector insurers, I think, grew by about 13% or thereabouts. And this is, I think, to a certain extent expected. Of course, the trajectory that you saw at the end of the year because of those changes in the norms and the taxation, etc., when you see that kind of even out, it's a reasonable growth, wouldn't you say?
It is. And again, I think they are trying to tweak their product mix, as you rightly pointed out, Alex, because last financial year with the tweaks in the tax rules, obviously they are going to get impacted in terms of the products that they sell, and that's going to have a significant impact both in terms of top line and the bottom line, and the management has not shied away from that. So I think the change in product mix is going to be something which will start turning the fortunes of HDFC Life. When it comes to the value of new business margins itself, I think most of the private players have delivered very strong numbers on this front. For the data in the month gone by, obviously I think HDFC Life delivered a very strong set. LIC has been a laggard in terms of both delivery as well as the margin performance as well. And SBI Life, as a surprise, had missed expectations in terms of the new premium growth as well. But when it comes to the cost structure, I think if you're probably looking at new products coming through, Alex, the commission and the overall operating cost structure for HDFC Life, along with ICICI Pru, which is consistently under-delivered in terms of numbers, might show significant increase as they start penetrating these products into their own database and the larger database as well. And somewhere I think that can take a hit in terms of the operating performance and the return on embedded value as well. So it might be a market performer at best. It is probably what we see looking at all these parameters.
A stock that has gained about 16% over the last month itself. Not a fresh entry. Do you wait or is there still value?
I think, as I said, we will wait it out because we need consistency in numbers to come through. And at best, I think it can be a market performer. So I think it can move in terms of what market can do.
UPL is a stock that saw a little bit of selling, and I'm not entirely sure what this is tied to. Perhaps to a certain extent, the kind of weather phenomena that we're seeing and the impact on crops, and whether or not there's damage to that extent, or whether it's going to impact demand for fertilizer. Is that what is playing out, and how do you rate UPL at this juncture?
It's a very interesting story, and the vagaries of weather obviously play out on these stocks quite significantly. Having said that, the kind of expectations that we probably have even now with the Russia-Ukraine conflict, specifically in areas of Eastern Europe and a better part of Europe as well, I think that push through will probably start happening. Now, the best part for all these companies within this space is that the input costs have gone down significantly. So you look at rock phosphate prices, you look at phosphoric acid prices, you look at ammonia prices have come off, which means that the input cost inflation that these companies faced a few quarters back, for this financial year, a large part of that element is largely going to be missing, and therefore I think the margins or the operating performance can be relatively better. Can the volumes hold up? In my opinion, it should, compared to last year, and therefore with volumes holding up and margins expected to remain stable or improve because of these factors into consideration, earnings might actually show some amount of bump up, in my opinion. I might be wrong in terms of how the weather conditions and volume growth turn out, but looking at the scenario 2 years, 3 years rolled over in terms of numbers, and assuming certain factors in the favor of the industry as well, I think they will be able to deliver a reasonable amount of growth. So anybody holding on can definitely hold on to a stock.
But fresh entries?
No, we will wait. I think let's wait for numbers to probably come.
Okay. The next one is McLeod Russell, and this is a board of directors approval for exclusivity agreement with Carbon Resources, and the agreement is to negotiate the monetization of certain company assets. I believe we're still awaiting certain details on that front, but what's your rating on McLeod Russell? Apologies, McLeod Russell at this point?
So frankly, don't cover it, Alex, but to a large extent, I think a sentimental push through if that happens, because they need to reduce debt on their balance sheet quite significantly. But for tea companies in general, whether it's McLeod, whether it's Harrison Malayalam, you talk about Tata Tea, Tata Coffee, I think the weather conditions in India are going to play a huge role in terms of both their pricing and demand. Looking at how weather conditions are playing out, if El Nino genuinely plays out by the end of August or September, and if conditions turns out to be a little bit worse, and if supply probably comes off, I think the pricing might actually start improving. The tea season, apart from sugar season, is different. I think the first flush comes out in May, and therefore I think this part of the monsoon will determine how next year's tea flush will probably come out. So I think just a little bit of macros for the industry as well, but no specific coverage.
Yeah, I guess wait and watch. We were discussing it this morning, Mayuresh. We're not deficient at this point anymore. with regard to the monsoon. But then more important, I think, for agriculture is spatial distribution. So we'll have to see how that picture pans out. UGRO Capital is a stock that is posted another business update. AUM has increased by 12% sequentially. And I think gross loans originated is quite an impressive growth on a year-on-year basis, 50% or thereabouts. Is that positive in your book, and how do you rate the counter?
It's very interesting, as you ask, because it's one of those new age companies which is dependent on machine learning, model learning, so on and so forth. They've captured 1% of the MSME database. And interestingly, as I was going through their annual report, their recent presentations as well, they've got a three-layered structure which is very, very interesting. They've got an EPL layer, a feature layer, and an algo layer as well, which probably tracks banking transactions, your last year's financial statements, and GST transactions as well. So the origination probably gets determined in terms of your credit history, your repayment history, and your strong financial profile as well. And therefore, liability as a service, as they call it, is extremely powerful. As they started off a few quarters back, and where they've landed right now, I think the AUM growth has been impressive. You're probably seeing both GNPAs and NPAs now probably coming under control to a large extent. 1.6% GNPAs compared to 1.7%. 0.9% net NPAs compared to 1.1, 1.2, if I'm not mistaken, and the collection efficiency is almost close to 98 odd percent, with the restructured book at 1.1 odd percent at this juncture. So a very interesting story. UGRO Capital AUM is expected to grow even further with the kind of tools that they've probably got at their behest. On the O'Neill lens, trades above pivot levels at this point of time. We would ideally, Alex, for counters within the NBFC space, see more institutional participation, because that's what we like at O'Neill. Because more institutions there ensures that a lot of due diligence has probably happened, and better the number of institutions means that they have a better hold in terms of how the performance of the stock might be. So I think that is the only lagging point that we've got. But yes, I think if we continue with the numbers, the momentum can very well continue.
And it's not a space that is lacking in opportunities anyway, the NBFC space and the financial space as a whole. The last group of stocks that I have on my list is the IT majors, TCS, HCL Tech, Wipro. Yesterday's session saw quite a bit of selling for all three of those names. They were the worst performers. Today as well, I think TCS is in the green, but the other two are languishing. Wipro just about flat, HCL Tech down about 0.6% or so. Is there broad expectation that this is going to be a bit of a washout in terms of business, and the outlook is going to be pretty bleak for the rest of this financial year?
So that's the consensus, Alex. And I think the IT stocks are probably going into the result season with very low expectations. And that's a very good sign, in my opinion. Because if they, by any chance, underdeliver, I think there might be a knee-jerk reaction, then the stocks might just have a time-wise correction. And therefore, I think the broad consensus expectations in terms of constant currency revenue growth for TCS is the lowest for this quarter gone by. Infosys has already given a guidance in terms of a weak show, probably for the better part of this financial year. There have been some expectations from the analyst community that the broad range that they've probably given, they might lower the upper end of the range. HCL Tech Mahindra, relative better performance within the large cap IT space. And therefore, I think numbers and management commentary is something that will probably rule the fortune of how these companies react. But the one good thing, as I said, is that the expectation is already low key. They might they might not deliver, rather, is the broad consensus that we probably have at this juncture. And therefore, if the performance is a lot worse, specific companies might have knee-jerk reactions. Otherwise, the normal under-delivery of numbers might ensure, as I said, a knee-jerk reaction and then time-wise consolidation on the sector. Our view is that you probably just wait it out. They are not showing signs of significant growth at this juncture, and therefore we'd like to wait out specifically for the large cap.
Okay, just a follow-up to that, because we have the earnings tomorrow. For these counters, apart from the headline numbers, which I think everyone will look at in terms of the guidance going forward and all of that, is there anything specifically that you would watch? For example, the size of the deal wins. I think they've been reducing in size, or even execution. Is that something, or guidance maybe on hiring strategy? What specifically are you looking forward to?
three aspects very broadly, Alex, for the sector as a whole. One, in terms of how the companies are probably looking at the entire ecosystem, banks, retail, manufacturing, specifically North America and Europe. That's a large chunk from where their orders are coming from. The second aspect, in view of the first point itself, are they seeing any amount of pricing pressures from clients or delay in terms of client tendering or ordering, as we call it? And the third element, in terms of the bench strength itself, they had a problem of plenty a year and a half back. And now they've got excess employees on their balance sheet. How do they probably account for all these requirements? Along with a lot of news that we are probably hearing in terms of media reports, that full-fledged variable payouts have probably not happened, or incentives as well. So what kind of an impact does that have in terms of all these three numbers put together on their margin profile and the outlook?
Fantastic. Okay. Thank you so much, Mayuresh, for taking the time. Pleasure speaking with you as always.
Thank you, Alex. Pleasure mine as well.
All right, viewers, there you have it. A whole list of stocks that we've discussed on this program. But there's lots more coming up over the course of the day. You'll find all of that right here on BQ Prime.
We all know about the India opportunity, but how large could this opportunity be? How long can the cycle run? And how deep are these options for investors? We try to get the answers from Nilesh Shah, Saurabh Mukherjee and Sunil Singhania to these questions at the India Opportunity Conclave on the 13th of July.